She sold half her company for $600 million cash. She's desperate to sell her empty houses. The public sees an insulated billionaire presiding over an infinite cosmetics empire. The institutional math proves something else: a brand losing momentum, a lifestyle burning through capital, and a forced liquidation of luxury real estate happening all at once. The question isn't whether she's rich on paper. The question is, what happens when the cost of being a billionaire outstrips the cash flow of a stalling brand? Kylie Jenner launched her cosmetics line in 2015 with $250,000 from early modeling earnings. The first run of 15,000 lip kits sold out in under 1 minute. Her digital storefront on Shopify Plus could process 10,000 orders per minute. No retail overhead, no middlemen. Pure velocity. Then came 2020. She sold 51% of the brand to Coty Incorporated for a total valuation of $1.2 billion. Her half stake yielded $600 million in gross proceeds, but the money didn't stay liquid. It flowed into irrevocable trusts. The KKJ 2018 Trust, King Kylie Holdings. A legal fortress against creditors. Also a cage. Once inside, that cash cannot be easily withdrawn. Meantime, she kept a 44% minority stake, tied to Coty's boardroom bureaucracy, and the boardroom numbers are brutal. Second quarter, fiscal 2026, total like-for-like sales down 3%. The consumer beauty segment, which houses her brand, down 6%. Kylie Cosmetics generates $351 million in annual revenue. Projected growth, 0 to 5%. That's not a rocket ship, that's a parked car. Here's where the cash bleeds. Kylie Jenner listed $68 million of luxury real estate at the same time. First, a 13,000 square foot Cape Cod mansion in Hidden Hills, bought for $12.05 million in 2016, listed for $20.25 million, then slashed by $2.26 million after just 5 weeks. Current ask, $17.99 million. Second, a 15,000 square foot concrete fortress on North Mapleton Drive in Holmby Hills, bought for $36.5 million in 2020, listed for $48 million. It remains unsold. The annual property tax on the Holmby Hills property alone, $476,445, plus a $13 million mortgage. At current interest rates around 6.4%, that's roughly $800,000 a year in interest alone. Add insurance, maintenance, security. That single empty house burns nearly $1.5 million annually. And Los Angeles has a mansion tax, Measure ULA, charging 5.5% on any sale over $10 million. So if she sells, the city takes millions off the top. The portfolio isn't wealth, it's a negative yield liability. Based on the $600 million buyout proceeds and the $68 million in active real estate listings, estimate Kylie Jenner's real liquid net worth. Write your estimate in the comments. We'll reveal the real number on the other side. The financial engineering here follows a family pattern. Borrow against assets to avoid selling and triggering capital gains taxes. The extended Kardashian-Jenner family has accumulated an estimated $132 million in home loans. Kylie's own Holmby Hills mortgage is part of that, but this strategy only works when the underlying business generates enough cash to service the debt. When the cosmetics brand stalls, the leverage turns toxic. The burn rate doesn't stop. Domestic staff operate through corporate entities, TriStar Services, Maison Family Services. A private Global Express jet costs between $50 and $70 million. Personal security runs upward of $3 million a year. Add it up. Fixed annual overhead exceeds $10 million in pure cash outlays. And a new 18,000 square foot compound is under construction. 12-car garage, 2-story wardrobe structure, tens of millions more in construction capital. The cash has to come from somewhere. That somewhere is the beverage aisle. Kylie Jenner launched Sprinter, a canned vodka soda, followed by K2O, an electrolyte hydration powder. She raised $12 million in Series A venture capital. In the first 4 weeks, Sprinter shipped 140,000 cases and landed in 16,000 retail accounts. But the ready-to-drink alcohol market is already saturated, valued at over $10 billion, dominated by High Noon and White Claw, filled with failed celebrity brands. This is an asymmetric bet. If Sprinter hits escape velocity, it could replace the stalled cosmetics cash flow. If it fails, the liquidation accelerates. The conglomerate bought her cosmetics company for $600 million. They quickly learned they couldn't buy the cultural momentum that made it work. She is trying to rebuild that velocity from scratch. Here's the real number. By our estimates, Kylie Jenner's total net worth is $670 million. That includes everything but liquid assets, cash, public equities, treasuries. Total just $262 million. The remaining $408 million is trapped in private equity, real estate, and vehicles. The liquidity ratio is 39%. That's medium on paper. But the liquidity quality score is 49. That's dangerous. Because most of her wealth sits in physical structures that can't be sold quickly without massive discounts and punitive taxes. The central mystery of this audit asked, what happens when billionaire overhead outgrows brand cash flow? The answer is on screen. Asset-rich, cash-constrained, forced to sell empty houses to fund a lifestyle that the business can no longer support. She was never illiquid in the sense of being poor. She is illiquid in the sense that her wealth is locked behind trust walls, mortgage covenants, and a stalled beauty brand. The liquidation illusion is real. The cash is bleeding, and the only way out is a bet on canned vodka. To the members of the Capital Logic Network who support our channel and make this possible, thank you for everything.